Hello, Baker University International Finance students. First, want to introduce myself. I'm Joe Barnhill. I'll be working with you all over the next 6 weeks. We have a very small cohort here, 3 people. So I was glad we got to 3 people because the forum discussions depended on that. So anyway, I'm looking forward to working with you over the next 6 weeks. This is more a reflective course. It's going to involve a lot of readings. It's going to ask for your participation in forum discussions. We're going to have weekly quizzes and also homework. Just start off first with the forum discussions. Look through the syllabus. I want you to kind of go through and pick from the readings that week. Like this week, we have chapters 1, 2, and 3 that you'll read. Something that interests you or something that you can tie to that's a current event article. I'd say current event is ideally like a month or less because things change so rapidly in international finance. We want to stay on top of data, what's happening with trends, and pick something you're interested in. Make your initial post by Thursday, and then follow up with your 2 other peers in the course by Sunday by midnight. And I'll jump into the forum discussion too and respond to your post. So because it is such a small cohort, I'll probably just be checking every other day, checking more towards the end of the week, once it's due on Thursday. But do always email me if you do have any questions. Email is the best way to get a hold of me, but you can call me by phone too. But I usually respond back to email like that day or the following day. With the homework, the nice thing is I put some spreadsheets out there. They're already templates for you. I think the homework is pretty straightforward. The answers are located in the back of the textbook. What I'm asking you to do is kind of come up with a formula within the Excel spreadsheet. If you're having issues, do email me. But they're pretty simple problems, kind of baseline to get an introduction to international finance, some exposure, some mathematical or quantitative thinking. But as long as you're making good attempts on this, you're asking questions, there's no reason why you can't get all the points in this homework. With the quizzes, you will get 2 attempts. What I would suggest is after you're done with all the readings, have your textbook available so you can refer back to that. They vary anywhere from 8 questions to 12 questions a quiz each week. You can go through the quiz once. It's a multiple choice quiz. And once that's done, you get one more attempt to do it over again. So ideally, you should be getting 100% on these because it tells you which answers you got wrong in the first go around. So just make sure to get that done and complete. With the forum discussions, they do have to be done in that week, or if they're not done in that week, you don't get any credit for that week. And the quizzes, they will close out at the end of the week too, so it's very important that you get those done on time too. And with the homework, there is a late day deduction if you're late, but hopefully if you just stay on top of things through the course, you'll be fine. So anyway, looking forward to working with you. That was a little bit of an overview of the course, but do look through Moodle, the syllabus, the rubric for the forum discussions. That's what I'm going to be grading you on, and ask me any questions if you do have any. With this week's readings with chapters 1, 2, and 3, just kind of looking at some of my notes, first, in the first chapter, it kind of talked a little bit about the Mexican peso, and it gave an example of a devaluation, like a percentage change. So the main thing that I'm wanting for you out of this course is just more that I leave with a greater grasp and understanding about international finance, and that's the objective of this course. And it talked about some of the euro-dollar market, the euro currency market. Euro dollars are dollars that are deposited at a bank overseas. It doesn't necessarily have to be US dollars deposited in Japan. It could be the Japanese depositing their currency in the United States. It also talked about the idea of comparative advantage. This goes all the way back to David Ricardo and global economic thinking, that certain countries may have absolute advantages in the production of goods, but they can't have a comparative advantage in both goods of production. So you're always better off trading, and that's why we live the standard of living that we do today, is because of through trade. And recently in the news, we've heard with the Trump trade tariffs, there's been a lot of questions of what is he thinking. The markets, stock markets, they reacted natively, and kind of we learned later he's backing off a little bit, but it does make investors nervous because it can lead to trade wars. Last with that, I just want to mention, when you're dealing with international finance and you're going to another country, it's really as a manager starting to understand all the rules and the risks and how the game is played. So it's going to be much different than it is in the United States. So you need to become an expert on that especially if you're going to be doing any type of direct investing over there, setting up a facility over there, or uh, being that you may have to pay in a different type of foreign currency. So they use a fictitious company, Ganado, throughout the textbook. So we'll see that again. Chapter 2 gives you a little bit more of the history. Talks about, going from the gold standard to getting away from the gold standard. The United States kind of came out of World War II as kind of a leader in that field, so it took the lead of trying to, after all that countries had gone through so much ruin to try to get, world economies reestablished again. So they took the lead, but today, even the amount of money we have in our economy is no way backed by the amount of gold that we have. It's really just sheer faith in the economy. But we still try to work with rules and agreements with each other. And markets, I'd say the foreign exchange market, I call it FX market, is the largest market in the world. Constantly buying and selling different currencies that are being exchanged and traded. And the price of those currencies are going to change too. So one of the things I talked about too in this chapter was the difference between fixed and floating rate. If a country wants their currency fixed at a certain exchange rate, they're going to have plenty of reserves of the other currency to go out and buy it. Like if they're worried about their currency depreciating, they're going to have to go out and buy that currency to bump up the value. If they want to keep it lower, they have to sell that currency. So the floating rate is what a lot of, I'd say, capitalist Western countries have today, where they allow the markets to determine, but there might be some intervention by monetary policy or the government sometimes to intervene in the market, depending on what the need is, whether it's for trying to get trade established again, or if monetary policy is going a certain direction, that can definitely impact the value of foreign exchange rate. We also talked about the idea of the impossible trinity, that you can't have exchange rate stability, free flow of capital, and monetary independence all at the same time. So you kind of have to make choices between those things. And last in that chapter, I talked about the Europe with the euro and the evolution of that, and the emerging markets that we see today, such as China and India. Last thing is chapter 3. It kind of gives a little bit more of like from a broad-based accounting level. This textbook doesn't go as much detail, but it just stresses the importance of economic data, how important that is. As managers, we have to be able to interpret that because we have to understand, especially if we're investing overseas or impacts to foreign exchange rates. The big three are like unemployment, GDP, and inflation, but these can impact us in different ways. So we have to keep an eye on these things and understand what's going on. In the balance of payment, and as the textbook authors stated, it's not really a balance sheet, it's a cash flow. The United States, we import a lot of goods, physical goods. We actually export more services, but from getting that funded, one of the things that worries about the recent trade agreements, or the tariffs, I should say, was that the Chinese might start to not take as many as the dollars they receive and buy U.S. Treasury bills, notes, and bonds. So that could be one of the consequences, and that's kind of the other side when we look at the current account and the capital account. So think of the capital account as more as the equity, purchase of stocks, bonds, foreign direct investment. The current account is more the savings, the FX, the foreign exchange, the trade between countries that make it happen, or I should say the cash flows between countries to make it happen. So if you're running a very high trade deficit, that means that other countries have to be funding that. So they're bringing that money in and buying, say, like I gave the example of treasury notes, bills, and other things. So, all right, well, that's it for this week. I'd like to just kind of give you an overview of the readings. I post these videos weekly to give you some insight. Next week video will probably be a little bit shorter. I just want to give you an introduction to the course, but I'm looking forward to talking to you online. And if you have any questions, do reach out to me via email. Have a great week.